Welcome to this tutorial. We are looking at the question called Taxperts. Now, before I start this question, please remember that to have the maximum benefit from this question, you should attempt this question yourself first and mark yourself to the suggested solution. Use it as an opportunity to first assess your own knowledge and then refer to this video. That is what I would recommend. Okay, so I'm going to start this question by reading through the scenario, and we'll talk about a couple of things that pop out and so forth. As always, I'll touch on a couple of things, maybe a little bit of high-level revision also. So let's go. It says, you are a registered tax practitioner working as a junior consultant for Taxperts, which is called Taxperts, a professional services company focused on South African tax law. Knowing that you are fresh out of CTA and that your knowledge is still fresh, your boss has assigned several queries to you. Okay, so we start with Peter Blakely. Peter Blakely, 23, was born in South Africa. However, 15 years ago, his parents emigrated to the United Kingdom. So 23 minus 15 is, what's that, 8. So he was 8 years old, basically. Peter studied electrical engineering at London University and completed his qualification at age 22. Now, before I continue here, when I tell you a person has emigrated, when I specifically use those terms there, unless there's something that really indicates otherwise, which shouldn't be the case, when they use those terms there, it means that a person has emigrated. Okay, so let's just quickly talk about immigration. Section 9H is the section that talks about immigration. Right, that is when a resident becomes a non-resident. That happens on the date of immigration. Right, right before that date, you deem to dispose all assets. And here are the most important ones which are excluded, except immovable property in South Africa and permanent establishment assets in South Africa. So, for example, if you have a shop in South Africa, okay, now you are treated as if you sold all of your assets at market value as a resident, and then you treat it here as if you bought the assets as a non-resident at market value. So you treat it as if you bought it from yourself. So that basically means this gives you a new base cost. That's section 9H. Okay, resident becomes a non-resident. When a non-resident becomes a resident, we look at paragraph 12. Well, actually, let me write it here. Paragraph 12 of the 8th schedule. So it's just the other way around. Right, so here's immigration, or immigration from the other side, however you want to see it. Right before, you deemed to dispose all assets except immovable property in South Africa and permanent establishment. It works in exactly the same way as section 9H. You treat it, deemed to dispose at market value as a non-resident. Now, what happens when a non-resident sells, well, not immovable property, what happens when a non-resident sells an asset that is located in America, for example? Nothing for South African tax, right? Then you here treat it as a resident, as if you bought the assets at market value from, right, bought assets at market value and that gives you a new base cost. So this is basically how it works. You have to just be aware of these things, but as a resident, it means this period over here is what's going to be subject to CGT. So you're going to use this as proceeds, and everything else before that basically is base cost. And this over here is what's going to be subject to CGT. But these assets, these immovable property and permanent establishment assets, they're subject to CGT the whole time. That's basically what these things imply. So that's in a nutshell how it is. Okay, let's carry on. Peter Blakely was born in South Africa and then immigrated to the United States Kingdom. Peter studied electrical engineering at London University and completed his qualification at age 22. Peter became aware of electricity for issues faced by South Africa, and he decided to immigrate to South Africa as he believed that there could be opportunities for his knowledge. Peter is a non-resident because his parents immigrated to the UK. He's a non-resident becoming a resident. So we're going to look at this paragraph 12 here. This whole story here. Peter formally immigrated from the United Kingdom to South Africa on the 1st of June of the current year of assessment. 1st of June. Okay, so this date over here is 1 June. So right before that, 31 May, that's when you treated this non-resident is treated as if he sold everything. So they basically just say you were a non-resident at that point in time and you sold everything as a non-resident because you're only a resident from the 1st of June. You sold everything at that time as a non-resident, and then on the 1st of June you bought it from yourself at market value but as a resident. Great, that's, again, I'm just reminding you. Then, this was the first time that he had returned to South Africa since immigrating as a child. Why are they telling you this information? Because, guys, whenever we have a non-resident, you have to look out for things like Section 10(1)H. It's one of the first ones that come to mind for me. Section 10(1)H is a section that tells you 100% of your interest from South Africa is exempt, except if you were in South Africa for more than 183 days. So this is why they give you this type of information. It also tries to maybe give us information about a physical presence test or anything like that, but they would have to give you a bit, obviously you can see it won't be applicable here. Peter has been staying with his uncle in Benoni, Johannesburg, since his arrival in South Africa. All right. Then they tell us information on Peter's assets is provided below. There's a flat in London. Okay, so this is a foreign asset. Now already, when you saw all of this immigration story, I'm sure your mind did go to this. If not, guys, obviously you have to go and revise that. This is a very important concept that automatically happens. They don't have to tell you that it happens. You need immigration, or immigration is the thing that triggers it. Right, so you were thinking about this process. Now, remember, as a non-resident, he's treated as if he sold all of his assets at market value as a non-resident. So this flat in London, what's going to happen when he immigrates? He's going to sell it here as a non-resident and as a foreign property. So there's no CGT implications at this point. Then on the 1st of June, he buys this property from himself, and that is the property's new base cost. Right, so Peter inherited the flat in London from his mother when she passed away 3 years ago. All right. The flat had cost his mother £150,000 when she purchased it 10 years ago, and on the day that she purchased it, the spot rate was 15 rands to the pound, and the applicable average exchange rate was 16.20. Right, now this is the mother's information, so maybe they'll ask us to do something with the mother, a CGT calculation or something like that. You would then use this. Although, again, the mother passed away 3 years ago, and remember the mother was also a non-resident. Because they immigrated. So so far, this seems irrelevant. On the date of his mother's death, the market value of the flat had been £190,000. Spot rate was 17 to the pound, and the applicable average exchange rate was 16.85. Okay, so on the date of his mother's death, so this was the base cost in South African terms, but it was the base cost to this person, what's his name, Peter, when he was a non-resident. So what I'm trying to say, if you apply South African tax law to that concept, it means for this period over here, when he's a non-resident, that is the base cost. But that has no impact on us. So I'm just pointing it out to you. We would use that logic in South African terms because you use the market value of the asset being inherited. But there's no application here for us. Still, foreign non-residents, foreign property. Since the day of his mother's death, Peter had been using the flat in London as his prime residence. Again, that might feel to you that it has some relevance to us, because we looked at things like the primary residence exclusion, but it's got nothing to do with us. And this is, I want you to just understand, you need to be able to see this in questions. Not every single sentence is going to result in an implication. Every single sentence should be considered carefully. But I want you to see, it doesn't mean you have to do something, have to do something with that necessarily. Okay. And again, why are we so unconcerned about this? Because all of this happened to non-residents during the time and to foreign property. So non-residents and foreign property, it has nothing to do with us. Every single day around the world, there are hundreds of millions of people doing transactions outside of South Africa who are non-residents. We don't care about all of their information. Same thing here. But consider it, you never know what's in there. Right, then, on the 31st of May of the current year of assessment, the flat in London had a market value of £210,000, and the spot rate on this date was 18.20. Okay, so let's quickly go here. So it says on the 31st of May, this is immediately before he became a resident, the market value they give us. So he's treated as if he sells it at that market value, and then he's treated as if he purchased it as a market value. So that amount will be his new base cost as a resident, because we only start calculating CET from this point. So this is the base cost as a resident. Right, that's all it means. It means he's treated as if he's purchased it for that base cost. Peter has been renting out the flat in London at a monthly rental of £1,200 from the 1st of June of the current year of assessment. Okay, now, remember he used it as a primary residence, now he's moved out, so that empty flat in the foreign country is renting it out. The 1st of June is when he became a resident. I'm going to just say here he's a resident, taxed on worldwide income. Then, on the 31st of December of the current year of assessment, Peter sold the flat in London to the person who had been renting it to him from the last 7 months. Okay, so he sold it to that person. The flat was sold at its market value of £218,000, so that's the proceeds. And the spot rate on the 31st of December was 19.20 to the pound. The average exchange rate for the current year of assessment is 18.90. Now remember, guys, a natural person can use either the average or the spot rate. Peter has indicated that he would like to translate the foreign currency into South African rand using the average exchange rate if that is available to him. So, remember the following. Section 25D says you can use the average, right? And we're going to have to also consider paragraph 43 here, because this is the disposal of a foreign asset in a foreign currency. Right, that's not a common one to see. That's why I thought I'd bring it in here to this question. Okay, basically what this section says, paragraph 43.1 says, it's proceeds plus base cost is in a foreign currency. So what you need to do is you calculate the capital gain in the foreign currency. Proceeds is 218,000. The base cost is only the base cost from the date that he became a resident, 210. So that's 8,000. How do you make that little symbol? pounds. Imagine that's a pound, I suppose. Wow, I don't actually know how to make it. And that you can translate either at spot on the day that it was sold or average. That's what paragraph 43.1 says. So that's what we're going to do there. That's as simple as it is. And that's if both of them are on the same currency. Remember, go and look at paragraph 43 just for the rest of it. Then, we've got shares in Trupo Limited. Peter owns 3% of the shares in Trupo Limited, a company situated in the Cayman Islands. Right, so these are foreign shares. Peter had purchased these shares for $600,000 2 years ago. Trupo Limited declared and paid an interim dividend of $1 million to its shareholders. So he gets times 3% of that. On the 15th of April, at this point he was a non-resident, because remember he became a resident on the 1st of June. And on the 31st of August of the current year, they declared and paid a final dividend of $800,000, so times 3%, to shareholders. So there was an interim and now there's a final. This, on the 31st of August, he was a resident. So as a non-resident, no South African tax will happen there. As a resident, it is gross income. Right, it's foreign share though. There are no taxes payable in the Cayman Islands on any dividends declared. Why is that important? Because if there were, you would have to consider Section 6 quite. But there's no foreign taxes, so we don't consider Section 6 quite. Section 6 quite, again, guys, is also only considered when you're calculating the tax liability. It's not considered on the taxable income. So you're going to do gross income, less exempt income, less deductions, blah, blah, blah. Then you get to your taxable income. That amount you multiply by 28% or the tax rate. And after you've calculated that, then when you do all of your rebates, you do Section 6 quite. So if they only ask you for taxable income, you won't do that calculation. Okay, Peter's shareholding in Trupo had a market value of $750,000 on the 31st of May. So what is this for again, guys? It's for this disposal. So that is what he's treated as if he sold it at, and that is what he treated as if he bought it at. So does the base cost for him, base cost as a resident on the 1st of June, and they tell you all amounts being correctly translated. So in this case, I want you to see, he gets a base cost here, there's no disposal or anything, so it's just information. There's no going to be CET here, from what I'm seeing so far. Right, then, South African bank account. When Peter was a young boy, his grandmother opened a bank account in South Africa for Peter, in which she deposited cash birthday presents. This bank account belongs to Peter and is in his name. There was 250,000 rands in the bank account on the 31st of May. That's nice granny. Right, this bank account earned interest as follows. So March to May, I'm just reminding you, he was a non-resident. This interest is all from a South African source though. Just please remember that. Why? Because it is paid by a South African, which is the South African bank. Right, so the March to May, he was a non-resident. It will be included in his gross income because non-residents tax on South African source. And Section 10(1)(h) will apply, it's exempt. Will there be any withholding tax on this? In terms of Section 50? There should usually be, but no, why not? It's paid by a South African bank. And you can go and find, sorry, that rule in Section 50D. Now remember, if it wasn't paid by a South African bank, if it was paid by someone else, like let's say a person like me, if I pay this person interest, then I would have to withhold withholding tax. June to February, at this point he's a resident, so it gets included in his gross income. We know because worldwide income. Plus, you can consider Section 10(1)(i) for that. Okay, then we have the house in Cape Town. Peter inherited the house in Cape Town from his grandfather 5 years ago when it had a market value of 1.4 million. Peter's grandfather had originally purchased it after 1 October 2001 for 1.1 million, and his grandfather used the house exclusively as his personal residence. Okay, so this is a little bit different from the one where he inherited from his mother above. Why? Because the grandfather is a resident and this property is in South Africa. So definitely this would have South African tax consequences. Now, this all happened in the past, but remember, you must be careful now, because this could maybe be asked. They could ask you, what were the implications when the grandfather passed away, for example. But what is important for you to understand here, so this was the grandfather's base cost, and then they tell you the market value was 1.4 million. So that would have been the proceeds for the grandfather when he passed away. Okay, but for Peter, this is Peter's base cost, because he's treated as if he got it from his grandfather at that cost. The house in Cape Town was let out to tenants. Okay, it's a business asset, so not a personal residence. During the current year of assessment, it generated a monthly rental of 10,000 until 31 October, the day that it was sold. Now, this is South African source, so taxed as a resident and as, well, let's say taxed as a non-resident plus a resident. Let's do it in that order. Both situations is taxed. The property was sold on 1 November for 1.6 million. That's proceeds. And they tell you the house in Cape Town had a market value of 1.55 on the 31st of May. So they try, what they're saying here is they say that's also the market value was on this date when right before he immigrated. But remember, this is immovable property in South Africa. So this was included and subject to CTT throughout. It's excluded from this rule, so it's not treated as if it was disposed of. So that base cost, when he inherited from his grandfather, is his base cost, not this. That's the trick here. And this is how this question is trying to test you if you really know those rules.